We continue with our discussion on the Unit 2 on wealth management, and we continue with our discussions around the investment instruments now. We've already looked at what kind of savings instruments are typically available in India. We now move on to the investment instruments, right? So first let's understand what is the requirement of investing money. What is the requirement of growing capital? What happens if we do not grow capital? Right, so we'll look at various investment instruments. We'll start with equities, then we're going to look at debt, followed by real estate, and then commodities, and then we'll briefly touch upon the alternatives that are available as well. Right, now when we look at investment instruments, why is it important for looking at investment instruments is why savings may not be sufficient for us. Right, assume that your yearly income is more than 10 lakhs and you will fall under the 30% tax bracket, right? In India, if you look at the tax slabs, and we're going to look at that in more detail towards one of the later sections, but primarily till 2.5 lakh rupees of income you do not pay any taxes. So till 0 to 2.5 there is no tax. Then 2.5 to 5 there is 10% tax. 5 to 10 there is 20% tax. Lakhs, this is what is lakhs. 5 to 10 lakhs income is 20% tax, and greater than 10 lakhs income there is a 30% tax, right? So if your actual income is greater than 10 lakhs, then you will find that your returns, which are being quoted by a lot of these instruments, let's say you get a return of close to about 8 to 9%. So on an FD, you will get a return of about 9%. Now remember, FD interest is taxable. So the return on FD is actually taxable. So what would your final return be? Because on this 9%, you would end up paying a tax of 30%. So your return would be only 70% of that, correct? So if I invest 1000 rupees, I end up making 1090, but on this 90 I will pay 30% tax. So what is left is 1063. That's 6.3% return, correct? Now this is the nominal return. This is the money I get in money terms essentially. So 1000 becomes 1063. But if inflation has gone up by 5%, then what I could purchase last year for 1000, today I need 1050 for the same thing. So what is my net return? My net return is only 13 rupees, right? That's 1.3%. Why? Because I had 1000 that got converted to 1063, but what I purchased using 1000, I now need 1050 for that. So what is left with me? That is 13, right? So these savings instruments, and this is when we have assumed that the FD rate to be 9%. In an environment where government is cutting rates on most instruments in India, fixed deposit rates have gone to 7-8%, in which case a lot of the saving guys would effectively not make any money if inflation hovers around 5%, which is generally the case in India. So it is absolutely important to look at beating inflation with a good margin. That's an absolute necessity that has come up now, right? So what is going to be required is capital appreciation. And for capital appreciation, we will have to look at instruments which are investment instruments and not necessarily savings instruments, correct? So on a post-tax basis, we would like to build our capital so that it can take care of adverse shocks in inflation, for example, right? So the first concept we try and understand in this is what is called as the equity. Now what is equity? Equity essentially means ownership. What do we mean by ownership? Let's assume there was a company which was here and they had the entire pie of ownership with themselves. At some point of time, they took out about 20% of their ownership and gave it to other investors, right? They did this by issuing shares to other investors. So in a way, there is a transfer of ownership happening from company to other investors And the company does this because the company raises money doing this, right? Now, what this allows is it allows an ownership into a company or a business, right? And what does that give you? If the company does well, what you earn is what the business earns. So if the business earns anywhere of to the tune of 13, 14, 15%, that's what your earning would be as an equity holder, as a shareholder. And that's why equities become extremely prominent instruments in terms of how do you go about investing your money, right, for the longer run. Right? So now let's look at the equity markets. There are broadly two segments of equity markets. It's the same market, it's the same exchange, but it's broadly divided into two segments. These are called as primary markets and secondary markets. Primary markets are markets where securities or equity shares are issued. The first time you issue a share or anytime you issue new shares, that's called as the primary market. Secondary market is where these same securities that were issued earlier are traded. So you can buy and sell securities in the secondary market, right? So whenever a company comes up with an initial public offering that's known as an IPO for the first time, what is being said is that they are tapping the primary market. The first time they issue shares, it's a primary market. Sometimes companies come back at a later point of time and issue more shares. So when you issue more shares, that's called a follow-on public offer. That's also on the primary market essentially, right? So whenever a company is issuing shares, the first time someone can trade on those shares, that's considered as the primary market. After that, the shares keep trading because there's always a buyer and a seller who are trying to kind of transact on those shares. This portion is called the secondary market. This is what we typically see as the stock exchange, where people are essentially trading and investing stocks. They can easily buy and get into the stock and sell and get out of the stock. The secondary markets provide you liquidity for easy entry and easy exit into the stocks from the stocks, right? So that's the broad objective of how equity markets are defined and why are they defined like that. Primary market is where securities are issued. Secondary market is where they're going to get traded, right? Now let's also look at some key market terminologies that could come in. So if you go to the National Stock Exchange website and you look at the website, it will give you a tab called, let's say, top 10 gainers. When you click on that top 10 gainers, it will give you a table like this. So this is the name of the company, right, in whose shares we are looking at. What is LTP? LTP is last traded price. So if we look this at time 11:12 p.m. or a.m., then in that context, whatever is the price at which the stock traded last transaction happened in the stock, that's called the last traded price. How much has this changed compared to yesterday? That's given in terms of percentage change. How much has the change been as compared to yesterday, right? How much quantity has been traded today? This says that for the stock GAIL, Gas Authority of India Limited, 5,50,797 shares have been traded during the day. You find for something like Sun Pharma, 18,30,029 shares have been traded during the day. So obviously that's more prominent. Now, if you call this as column 1, 2, 3, then the value in lakhs is nothing but all column 1 into column 3 that has been traded. Now, it's not exactly column 1 into column 3 because this is only the last traded price. It's quite possible that shares may have traded at 370, 371, 372 and so on and so forth. Whatever the price multiplied by the volume, price multiplied by the volume, price multiplied by the volume is going to give me the total value in lakhs. Correct? So for example, 100 shares trading at 370 and 100 shares trading at 371 are going to come in as 37,000, and let's say this was 371, 37,100. When you add the two, you're going to get 74,100. That's the value that is going to come here in value in lakhs, right? Then it talks about at what price did the stock open during the morning. So the markets open at 9:15 in the morning. What price did it open at? What is the highest price it has made till now during the day? What is the lowest price it has made till now during the day? And what is the last traded price is anyway given to us? What is the previous close? At what price did it close yesterday? Right? Now the last two columns are not very important, but this CA is nothing but any kind of corporate announcement. Every company will have to make any kind of changes that they do on their financials, any decisions that they have to make those decisions available in the form of corporate announcements to the stock exchanges for the benefit of investors. So let's say a company goes and buys another company, that will appear here. If a company has a meeting in which they are planning a new capex, that will have to also come here. They'll announce that, right? And then the company may have declared what is called as either a dividend. Usually this is the dividend. On what date that dividend will be paid, that's called the latest X date, right? So on what date a bonus share. Remember, we have discussed some of these in the previous semesters, that these kind of dividends or buybacks or bonus issuances that companies do, these are corporate actions, corporate announcements. The latest X date is the date on which any such action would have happened. So what happened on 2nd March 2015? If you click on this, you will find that data. So these are some of the key market terminologies that are there. These are the top 10 gainers. You could similarly have top 10 losers, right? Now, if you click on any one particular stock, so if you go to the stock of Lupin, for example, and you click that, that's the name of the company, right? That's the quotation on a particular date at a particular time. This is the symbol at which is basically used by the NSE to identify this particular stock. There is a unique code associated with every stock called ISIN, right? Stock identification number. It's a listed stock, and now you look at the same data. This is what is the last traded price. This is the change from yesterday. This is the change in percentage terms. Last day's close, today's open, today's highest point, today's lowest point, and this is the price at which we closed, right? At which we closed during the day. You look at a few more data points. So you first see what is called as a volume weighted average price, right? So effectively, if you were to look at the total volume, total value that got traded, and total number of shares that got traded, and you divide this 4 by 3, you will get this data. Not very important, but probably at a later point of time when you get deeper into these aspects, that will give you an idea on roughly on average. What it says is on average it traded at this price during the day, right? We will come to the concept of market cap and free float market cap in a few moments from now. Broadly, this stock in the last 1 year has hit the highest point as 2029 and has hit the lowest point as 1280, right? And on what dates has it done that? That's basically given. And then you have a lower and upper price band, which is what is the maximum daily move allowed. So beyond this, the stock exchange will not allow the price to go, and it will trade there, right? Then you will look at some company information available here, some peer comparison available here. And if you want to get data of stock prices for the last few months, few years, that's available in historical data. You can also look at charts which are available here. They talk about what is called as the buy quantity and the sell quantity. Now let's understand this buy quantity and the sell quantity and what is the terminology used for that. When you are buying something, typically you can say I want to buy 100 shares at 1541, and a seller might say that they want to sell 455 at 1544. Now the price doesn't match. Let's say at some point someone else comes and says, I want to buy 50 at 1544.7. The moment these prices match, the transaction for 50 shares will get executed. Right? So the stock exchange is basically trying to match buyers and sellers. The price which the buyer quotes is also known as bid. The price which the seller quotes is also known as ask. So in a sense, this table here is what is called as a bid-ask table, right? So those are the various parameters that we would want to understand with respect to equities. When we look at equities, there are, as we see, some other data points also which are available. We don't necessarily need to get into details of those at this point of time. We're primarily looking at what is a high, low, what is a 52-week high, what is a 52-week low for a particular stock, right? With that, we would come to an end to this particular section. We'll continue with our discussion on equities in our next video. Till then, a couple of questions that we need to answer are: what is the difference between the primary and secondary markets? And explain why investments are necessary for any individual. Why can't savings suffice for an individual?